Fellow investors, bonjour. My name is Mike Yahoo and I'm the founder of Dividend Stocks Rocks. I'm also a passionate investor with this YouTube channel to help you invest with more conviction so you can enjoy your retirement. Today, we're going to talk about renewable energy stocks. I like them. You know that I believe it is going to be a great investment opportunity, but unfortunately, over the past 2 years, it has not been fun. Even worse this year, many renewable utility stocks are just going down like there's no tomorrow. So are you going to get burned with another Algonquin episode, or what's going to happen with the others? Today we're going to look at 5 companies that are not doing so great right now, but one of them is actually interesting. So let's go back first to what happened this year with this graph where you see NextEra Energy Partner, NextEra Energy, Brookfield Renewable, Energex, Northland Power, and Atlantica Sustainable Infrastructure. Few companies here, all in the same industry, but there is definitely a problem because you can see all of them going down and even deeper over the past few months. So what really happened over there? Because those are like definitely not the type of investment you want in your portfolio, right? And so first, you have to put everything under perspective. Renewable stocks went onto a strong bull market before 2021. So now I'm just showing you what happened after the peak, and it's all downhill from there. What's the worst part was an announcement from NextEra Energy Partner a few months ago. Rewind back into September. So what happened is they kind of made a review and say, yeah, we are not going to increase our distribution by 12 to 15% per year anymore, because it was a crazy dividend grower in that aspect for the past like 10 years or so. But then they say we're going to cut it off roughly by half. So it's going to be an annual growth of 5 to 8%. So first, you have to look at what really happened there. It's a yieldco, so a business that its sole purpose is just to generate distribution for NextEra Energy and obviously shareholders. And the goal was to just increase it over and over and over. So the previous target was 12 to 15% per year, and they have been doing that for a few years now. So that was all going well. But then they said, you know what, we're going to revise that to 5 to 8% annual growth rate. So first, you're going to say, well, 5 to 8, isn't that bad, right? So how come the stock is down like more than 60% in a single year on that announcement? Because like after that announcement, it was like going down double digit every single day until now. There's like some kind of like a market fatigue where everybody just like, you know what, forget about that. We're just going to drop the ball. So let's take a look at what is the difference between NextEra Energy Partner and NextEra Energy, because there's a big difference here. So as you can see on this graph, NextEra Energy Partner drove all stocks down, including NextEra Energy, which is the parent company, but not as much, because there's a big difference between being down 20% or being down 63%. So first, let's put everything under perspective. NextEra Energy is a lot more diversified. They are the leader in renewable energy in this segment. And they have a market cap of over 115 billion. As to Next Energy Partner, it is a yieldco where it gets assets from NextEra Energy, and it just generates distribution with a market cap of 2 billion. So the big problem here is with NextEra Energy Partner, their business model is all about getting as much financing as possible to acquire as much assets as possible to generate as much distribution as possible. So when interest rate goes up, it obviously crippled their ability to increase their distribution. So that explains a part of why the company struggles to say, hey, we're going to offer you a double-digit dividend increase every single year. But that's only the first side of the story. The second side is NextEra Energy Partners also is pretty big on issuing more shares year after year, so they get that source of financing which work very well when the stock price goes up. So then you just issue more shares and nobody really care about share dilution and everybody's happy because they're partying, right? So then you can use that money, buy assets, and then generate higher distribution. But today that distribution comes like a debt for them, and now issuing more shares when your shares price are down 63% is not really an option. And when you go back to the financing option, you realize, oh my god, the interest rates are higher than they used to. So now they're facing a very tough position. So what's going to happen with NEP Energy Partner is, the best case scenario is they're going to survive the next 2 years and hope for lower interest rates. And after that, they'll be able to get a little bit more financing, buy a little bit more assets, get a little bit more love, and then the share price goes up. So that's the perfect scenario for them. So far, they mentioned they have enough liquidity to finance their project over the short term for the next 2 years. So this is what management hope it's going to happen. The worst case scenario is NEP Energy just say, you know what? We're done with this. We're just going to buy back in NEP Energy Partner because the valuation is so low that it would make sense for us to buy back all the assets and put that company private. So it would be a pretty solid move for NEP Energy, but not so great for investors because they're not going to get like a major upgrade there. So maybe we're gonna see the stock price goes up by maybe 10 or 15% or something like that, but you're not going to recover what you lost this year. So now it's all about, is NEP Energy Partner can go through the next 2 years with their own financing, what they have in their balance sheet, and after that hope for A, lower interest rate, and B, a higher stock price. What's gonna happen? I don't know. Your guess is as good as mine. So again, when you chase yield, there's no free lunch in finance, and there is risk even if the company has shown a steady dividend growth rate. So now you probably ask yourself, well, is it worth to invest in utilities that are offering renewable energy? And if so, because they're all depreciated right now, so usually when an entire segment is getting hit, there are a buying opportunity that you can find. So what would it be and how you can determine it? Well, you're gonna see me coming. We're gonna look at those with the dividend triangle in mind. So the first one we're gonna look at is at the Atlantica Sustainable Infrastructure. That is also a yield code that belongs to Algonquin, so already you may not feel that comfortable buying this one. There are also two problems that I can see in the dividend triangle. Is the first one, the revenues are going down since 2022, so that's not good news. And the second thing is there's no more dividend increase since half of 2022, so nothing in 23. This shows you that there's definitely a problem, and as you can see, the stock price started to decline about the same time where revenues are slowing down and then dividend has not been increased. So for this one, I would definitely go ahead with that. I used to like this company a lot from an investment perspective if you're looking for a balance between growth and dividend. Because as you can see, before that, 2019, 2020, 2021, everything was going up, and then boom, nothing is working anymore. So this company has a little bit more problem. Same story where issuing units or getting more financing with higher interest rate cripple their ability to generate higher cash flow from their assets. So while they benefit from long-term contract with government, it seems that it's not enough for them to be able to generate higher dividend distribution year after year. Moving on the Canadian side now, we have Innergex Renewable. This one never liked it that much. This one was really about potential. So you buy it and then you hope that they get a bunch of contracts. They deal also with Hydro-Québec, which is a company based in, well, a government-owned company based in Quebec, so 100% owned by the government. Looking for partners for solar panels and wind farms. Innergex was just like, hey, pick me, pick me. So that was great, but as you can see, there is definitely a problem with the dividend growth rate. It has stopped in 2020. So then first reflex you have to do there is to look into the financials and see what really going on. Well, what you're gonna find in the financial statements is the free cash flow and the payout ratio are not doing that well. So as you can see, the payout ratio is at 121%. So definitely for a business that is in growth mode and is looking to invest massively in their projects, they definitely do not have enough money to pay out increase for their dividend. Actually, at one point, chances are they will have to look at cut it off, because 120%, it's definitely very high. And right now, they do not have the balance sheet to get cheap debt or issue more shares, as the shares price have gone down. So they're getting squeezed once again. So the difference between NextEra Energy Partner and a company like Energex is NextEra Energy Partner can also be bought out by their parent company, while Energex, well, they're on their own. Another one in a similar situation, another one that I didn't like that much, because again, it was all about buying it for the potential, but no numbers to show for it, Northland Power. So once again, we have a company that shows some interesting trend between 2019 and 2021. But then while revenues are going up like pretty much steady, there's absolutely no dividend increase over the past 5 years. So then again, you should ask yourself, well, what's going on with this business? Well, this business focuses on growth and not on the dividend, but still it shows some kind of like a problem that going forward, maybe that Northland Power, now that it's operating in a harsh environment where it's harder to get financing, may go into trouble. What could have seduced a lot of investors about this company? It is well-diversified business. So they do business in North America, in Europe, and in Asia. It's almost like one-third, 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 which is great. They also have wind farms and solar panels. So again, trying to offer you a great looking business model. When you look at that, just like, yeah, this is the type of business I would like to have, where you're well diversified in terms of services you offer and also in terms of countries that you deserve. So overall, it seems like an interesting investment. Unfortunately, Northland Power does not show any dividend growth when the market was nice, when the economy was easy. So what's going to happen next? Well, obviously no distribution increase, maybe something worse. So now let's take a look at the last but not the least investment opportunities in this sector, Brookfield Renewable. On this graph, I decided to take BEP, so Brookfield Renewable Partners. The reason is quite simple, is this one exists for a while the new one with the corporate shares, BEPC, it's the most popular. Why? Because it is a corporate class share, so regular shares. Regular shares means it's easier to deal with taxes, so ETFs and funds are more attracted to them, some retail investors as well. For the partners or the trust units, it's a little bit more complicated for tax-wise. They usually will offer a slightly better yield than the corporate class shares, just because of demand, because the company is the trust. The units, the shares are tracking the same business, they're paying the same dividend, but the stock price will fluctuate differently. What's interesting here is you may think that there was a dividend cut in 2020, but it's not a cut, it's because they decided to create those corporate class shares. So big warning here about anything that you were going to buy with Brookfield, they like complexity. So they're always doing some kind of move like this, going from trust and units going to corporate class shares, pinging it off. So the trust unit holders actually receive shares, so they didn't suffer any dividend cut, and it actually continued to increase. It's a little bit harder to understand, you need a little bit more time, and if you don't feel like it, well, it's definitely not the right investment for you guys. But again, if you're interested in going a little bit deeper, well, follow me into the rest of this video. So what I like about Brookfield Renewable is similar to Northland Power, but just bigger. So well diversified across countries and even more diversified across energy source. So we're talking about hydroelectricity, wind power, solar power. They also distribute some of that energy and they offer storage. So they're well diversified in their assets and their services, and in terms of geography, it's the same thing. So they have a better power, better diversification, not going to be hurt because one country is struggling or one part of their their assets is struggling, they do have a good business model that has been proven to be quite stable in the future, in the past. One thing that struck me when NextEra Energy Partners, announced that they were reviewing their distribution and drag all the stocks down is a few weeks before Brookfield Renewable had their investors day, literally 2 weeks before NextEra Energy Partner. And in their investors day, they said something completely different. So they started showing you this graph. So distribution growth over the past 10 years, 6% annualized growth rate. FFO per unit growth over 10% annualized growth rate for the same 10 years. And then they said, you know what? For us, it's business as usual. Our target remains to increase our distribution by 5 to 9%. It was that for the past 10 years, and it's still the same thing today. So when you have NextEra partners that is struggling and say, yeah, we have to modify our distribution growth policy, we also have Brookfield Renewable saying it's all good. So at this point, it's really a matter of, do you trust management that has proven that it can do very well over the past more than 10 years actually, or you're gonna go take a chance in the hope of a growth that is promised but not necessarily delivered. Obviously, Brookfield Infrastructure, we do have this strange feeling when you look at the financial statements. It's a little bit hard. There's a part of it that is completely opaque, that it's impossible for you to analyze, and this is the reason why, even though I love those type of companies because they have a great proven track record, it's not going to be a major investment in my portfolio because I don't want to get hit too much if there's anything that goes wrong that I cannot see. But if it's a risk that you're not willing to take, well, then you have to consider it very seriously. For my side, I do have shares of Brookfield Infrastructure and Brookfield Renewable in my portfolio. Again, they're not large investment, but they're still there in my portfolio because I believe in their ability to grow going forward. For Brookfield Renewable, if I look at the current state of utilities that offers renewable assets, I would say that your best bet is probably a utility that is first regulated utilities with classic ways of distributing electricity, then as growing a part around renewables, instead of going for all-in renewables that is definitely a little bit more shaky, but on the other side will offer a greater returns if the market decide to go back and give them more love. Going forward, I don't see classic energy utilities outperforming if they're polluting that much, because regulation is not on their side, and the rise of electric vehicles and so on will create more demand for more sustainable and renewable energy sources. Again, that is also one thing that needs to be yet proven on the market, and renewable energies needs to generate a lot more profitability without subsidies. And for this time, as technology evolves, it should happen. But for now, you'll have to be very patient and not necessarily expect to generate a big return right away. So I hope that you have enjoyed this video. Let me know if you are investing in renewable energies right now, which is your favorite stock, or if you have any specific questions. And next week, we're gonna talk about your favorite topics. We're gonna make a review of the Canadian Bank's earnings report. Until then, don't forget to stay invested.